In this video, we discuss why some people bash target date funds. Coming up next on Holy Schmidt.
Holy Schmidt!
Target date funds, often called age-based funds or lifecycle funds, get their name from the year in which the person plans on retiring. They're one of the most common ways to diversify one's portfolio, and they've been used for decades to rebalance and professionally manage the funds within them. Approximately 60 million Americans own target date funds, and the structure has been credited with keeping the investments safe for a lot of people for a very long time. So why are there books, articles, and even videos on their limitations? Well, the reason is because they have a one-size-fits-all structure that doesn't fit everybody's investment needs, and having more information is better than having less, even if you choose to do nothing with it. By the way, stick around to the end, because after we go through the video on why people don't like target date funds, I'm going to talk about 2 or 3 key features that make them really, really appealing. All right, let's go. The one-size-fits-all structure. The target date fund assumes that everybody has the same risk profile if they have the same date in which they plan on retiring. The fund assumes, for example, that if you're 6 years out from retiring, that you should have the same equity and fixed income balance of investments no matter what your age and no matter what your risk tolerance. Your 2030 fund will have the same balance of equity and fixed income as your neighbors, even if you're 15 years apart in age. The reality is that a 52-year-old will have a different risk tolerance than a 67-year-old if for no other reason than the 52-year-old can continue to work if things aren't going well with their investment portfolio, while the 67-year-old will have limitations in this regard. If we have another year like, for example, 2022, where the target date funds, the vast majority of target date funds, had a staggering loss, then the 67-year-old would just have to go forward with less, whereas the 52-year-old might be able to work for a few more years and pull their portfolio value up. The next point is lack of diversification outside of the fund family. Target date funds invest, generally speaking, in the same family to which they belong. And so a fund might buy a portion of the world equity index of the family and maybe another portion of the world bond index. Effectively, it's a fund of mutual funds in most cases, but the problem is that if the fund family itself has a specific investment strategy that doesn't do well, the person making the decision on where to allocate has limited options. Which brings me to my next point. A target date fund can be too broad in its investments. The reason is that these funds de-risk the structure by investing in a broad number of mutual funds, and those broad number of mutual funds are already invested in a broad number of equity and fixed income products. For example, a fund that invests in a mutual fund that's a complete stock market index means that they're investing in the total stock market. Now you say, Jeff, I don't want my fund manager to place bets on individual stocks. I want diversification because I don't want them to try to call the winners. I hear you, and I agree with you. But what about the losers? Because those are much easier to call in many cases. It wouldn't take a genius to know that Cinemax Holdings, the parent of Cinemax Dine-In movie theaters, wouldn't be a good investment in March of 2020. The next point is that an age-based fund may charge higher fees. The fact is, when you buy a fund, the fund manager charges a fee. If that fund invests in other funds with other fund managers, they also charge a fee. So in many cases, you're paying fees on top of fees. And the reality is oftentimes there isn't a difference in the performance of the fund based on the fee. A lot of that comes down to branding. This dual fee structure is basically paid for the fund manager getting the balance right. So in essence, you're paying the fund family 2 times. Of course, how much depends on the fund family, but if you assume that you're paying a fee for every value add component, you probably won't be wrong. This means that it's supremely important for you to understand the fee structure, not only for the fund you invest, but the funds in which your fund invests as well. The next point, target date funds don't know about your other investments. This one point alone means that you probably are over or under allocated in one particular asset class. Let me explain. For this example, either subtract a 0 or add a 0 or other, depending on your actual assets that you have, but let's use just a $100,000 investment. If you had a $100,000 investment and 50% of that investment was invested in equities through your target date fund and 50% was invested in fixed income, and of the 50% in equities, 50% was invested in domestic equities and 50% was invested in international equities, you would have an approximate allocation that a lot of funds start with. They move out from there, move in from there, but that's the typical starting point for a lot of these funds. However, what if a long time ago you put a bunch of money in an S&P 500 index fund and now you have $25,000 in your S&P 500 index fund outside of your target date fund? Well, now you have 60% equity and 40% fixed income in your investment structure. And instead of having a 50-50 mix of 50% domestic equity and 50% international equity, you have 67% domestic equity and 33% international equity. Or, and this is invisible to a lot of people, what if you are a big holder of your own company stock? This isn't uncommon, by the way, particularly if you're mid-level or above within an organization. Now you have market risk on your equity, your company equity. You have performance risk on your company, and you have personal job risk with your company as well. If things are going well, what happens to your company share price? Well, it goes up, and potentially your career goes up as well. But what if things are going badly? Well, your company share price goes down, you could lose your job, and if the stock markets are crashing at the same time, you've now taken a huge hit, not only in your age-based portfolio, but also on your personal holdings as well. So the risk is that you lose your job, your outside investments go down, your company stock either goes down or in an extreme case becomes worthless if the company goes out of business. All of the time you need those investments to be performing well. The next point is that they don't always risk adjust the way that you expect them to. In 2022, there was a really bad hit to the age-based, the target date funds in their performance. And that's because of a lot of different things. In fact, at the end of this video, I'll put a link to another video on this particular subject. So stick around to the end so that you can see that. But in the meantime, let's talk about this issue. The safety net of a target date fund is that typically when stock markets are crashing, people are selling their equity and they're buying the safety of bonds. So bond prices are going up. But in 2022, the Federal Reserve Bank was raising interest rates rapidly to curtail runaway inflation. Rising interest rates have a tendency to make existing bond prices go down. The reason is that the outstanding bonds, the older bonds, have a lower coupon rate than the new bonds because interest rates have gone up since they were sold. So in 2022, a target date fund that owned bonds, outstanding bonds in a rising interest rate environment, and equity that was falling lost a lot of money. Of course, the opposite can happen as well. In fact, you're seeing a bit of that now, and no one complains when bonds and stock prices are both going up. Now, the other side. As much as people like to bash target date funds, they have a few really great features. The first is they act as a surrogate financial planner for those that can't afford one. A financial planner will interview you, look at your risk profile, and allocate investments based on you specifically, customizing that balance particularly for you. A target date fund doesn't do that, but it gets a lot closer than someone who just picks stocks and bonds themselves. This is particularly useful if someone is just starting out on their investment journey and don't have a lot to invest, but want to sleep better at night. Later, you can always hire a financial planner once your portfolio gets to be of the right size and have your portfolio customized, but the 80-20 rule applies here. You get 80% of the results from 20% of the effort. The next upside is that you don't really need to think about the rebalancing activity yourself because the portfolio does this for you. As you get closer and closer to retirement, the fund manager sells equity and buys fixed income products, generally speaking. Next, the minimum to get started is quite low. You can start in most funds for $1,000, some even less if you get the right fund. Why are they doing this? Why are they letting you start with only $1,000? Well, most of the time, people don't start with $1,000 and say, this is all I'm going to invest. They continue to invest over time And they're hopeful that that little seed that you plant with their portfolio family, their mutual fund family, becomes a giant tree over time. $1,000 today becomes $10,000 in a few years, and that becomes $100,000 in a decade or two, and that continues to grow. At least that's what they're hoping for. And of course, the portfolios are professionally managed, which means that the manager pays attention to a lot of things that the average investor doesn't pay attention to. Little things that make a big difference, like ratios, percentages, and performance issues within the fund. Whether a target date fund is right for you or not is a matter of your personal circumstances. Some people swear by them. Others want to manage their portfolio a little bit more actively, often to avoid some of the fees that come with these funds. If you like this video, check out that video, the one I talked about earlier on what happened to the average 401k balance in 2022, and it goes deep into the target date funds. This is Jeff Schmidt. Thanks for watching.